Welcome to the Techno Fundamental Report for August the 7th. Which pond do you want to fish in? Do you want to fish in a pond that has big bass and sac-a-lait, or do you want to fish in a pond that just has catfish in it? You know, institutional investors drive the market, and I think it's important to focus on their activities. So you want to fish in that pond, which means you want to identify, you want to think like an institutional money manager, because you want to see the things that they're seeing so that you can take advantage of it. So there's a lot of ponds to fish in, but I would recommend that pond. Now, we've been having some controversy here over the non-farm payroll report, revisions that were absolutely ridiculous, totally out of line. As a result, Trump has fired the Commissioner of Labor Statistics after weaker than expected job figures slam market. And everybody out there wants to say, oh, it's because they're manipulating numbers and so forth. No, the bottom line is that the technology being used to calculate these numbers is extremely outdated. In the 70s and the early 80s, they would do these surveys to determine employment. And approximately 90% of the recipients of the survey would respond. Well, now we're down to like 30% are responding. So the problem here is not anybody manipulating the numbers. It's just that the system we have is outdated and needs to be updated. And as a result, the person that was in charge of this thing is getting fired for a reason. And I think it's a good reason. So the point I'm making is that they need to revise the whole system, because us as investors need to have reliable numbers. Just like with the Federal Reserve, we want to see reliable numbers, but we just haven't been getting them. Powell's got a pretty bad track record. So what's happening here, I think, is just incompetence, and we need to make a change. So here's the unemployment number for July. Came in at 4.2, so it's pretty much right in line still. It's just the revisions that were so troubling. In other words, the revisions were quite, difficult. Now, I want to talk a little bit about defense spending. Next year, the estimated budget for defense spending is $1,011 billion. Now, this is an opportunity because the military spending is not going to go for big tanks and big metal things. It's going to go more for things like robots and flying aircraft. So if you look at this particular company, this company is called Anduril Industries. They're a private company, and their real big is the ability to defend us against certain attacks. And this is a private company, but I think it's something you really want to keep an eye on. This guy Palmer Luckey is very interested. So we know the defense budget's going to be over $1 trillion. So who's going to get that money? And so if you look at a company called Palantir, they are very involved in software and AI equipment for the military, and they also do commercial markets as well. But the main point here is that they are developing new technologies that are going to be in the priority for the defense budget. So Monday night they announced their revenues. They came in at $1 billion for the first time. So on an annualized basis, moving forward, that $4 to $5 billion in annual revenues. But if they're able to capture 1% of the defense budget, that's $10 billion. Now, what if they capture 10% of the budget? Well, that's $100 billion. So the potential here is great, and you should keep an eye on Palantir. And it's mainly due to the fact that the military is just upgrading and improving their technology, and they're in the middle of it. So let's just look at the market for a minute. Again, here's our final low, which we think was a final low. We're continuing to track the 21-day moving average and holding it. Now, we are in a power trend here. We are in a power trend. Now, to end the power trend, it's very simple. The 21-day crosses below the 50-day in a death cross, but that's not happening. So we're still in a power trend. This is an uptrending market. Same with the S&P 500. You can see here we made the final low here on April the 7th, and we are currently in a power trend, and basically we are in a bull market. So the primary trend is up. We're above the 200-day moving average. Things are looking very positive. The aggression index actually hitting a new high here. This is basically saying if you're going to get aggressive, this is the time to do it, is what it's saying. Now, we'll take it a day at a time. You know, tomorrow could be different, but right now everything is falling into line. Interest rates are under control. Employment, we're basically at full employment. So our power index continues to be below zero, and it basically is saying that interest rates in the free market, in the actual market, are really starting to stabilize and come down. You can actually see that interest rates are pretty much in a downtrend here, which is telling me the Fed's going to cut rates. Volatility index, we had a little bit of a spike, Friday, but it's come right back down to 17 again. We really got down here in the low area, but the volatility index is continuing to look constructive. Oil prices are still in a downtrend. You can see here, high, low, higher, lower high, lower low. It continues in a downtrend. So, I would basically say that I would stay away from energy stocks for two reasons. One, price of oil is in a downtrend. The other is that the earnings estimates for the oil industry, the exploration companies, is at the bottom of the deck. In other words, technology projection over the next 12 months, growth rate in earnings is about 18%. The S&P 500 is 10 to 12%, but energy is zero. So I would kind of stay clear of that group right now. Now, new lows did pick up a little bit here on Friday, but we're back below 40, so things look like they're stabilizing there. Now, a lot of people are talking about how great, international stocks have been doing. Now, I don't know if this is tariff related. I don't know what the deal is, but I can tell you this. I have done a comparison here, a ratio here, comparing the Eurozone to the S&P 500, so Europe versus the U.S. It has been in a downtrend for 20 years. And so we've gotten this bounce here, and everyone's, shifting their asset allocation to go more international. It's still in a downtrend. And realize, too, the United States is the only place that has favorable demographics other than India. And India's got so much poverty, it's kind of hard to calculate. But I would simply say that I would stay with the good old USA with my investing right now. So if you have any questions, please let me know. Thank you very much.